On behalf of CrossCheck Media and BizTalk Today TV, welcome everyone to the Money Path. I am your host, Todd Schoenberger, and happy Veterans Day to all of the veterans out there. We do thank you and salute you for your service and hope you have a wonderful day today. Joining me today on the show is Vincent Randazzo. He is the founder and chief market strategist at ViewRight Advisors down in chilly and super cold Jupiter, Florida right now with this cold snap rolling in. But one thing that is actually not cold and is really hot, piping hot, is the stock market right now, Vincent. You have the S&P 500 is near an almost all-time high. Again, we're up over 16% for the year. So with that, and just taking your recent report that is titled Rethinking Risk Management, my question for you, and that report is great because it really talks about how trading losses, the bulk of trading losses and the bulk of trading gains cluster around stress periods, total stress periods in the markets. With that S&P up so high, how do you define a stress environment today?
Yeah, I think that it goes back to my roots, which is breadth analysis, right? I've been doing that for probably over 2 decades now, studying market breadth, investor behavior, working with financial advisors and money managers. And why breadth? Breadth is one of the simplest concepts in the market, but it's the most reliable indicator of market health, at least that I've been able to find. So for me, if you just measure what it talks about here, which is how many stocks are actually participating in the trend, which is a forward-looking view of market strength, if you think about it. And to hammer home that point of that forward-looking nature, I use the analogy of a freight train pulling a mile of cars, that's good breath, versus 100 feet of cars, that's bad breath. Which of those trains is going to be harder to stop and reverse, right? The one with a mile of cars. So that's the idea. When you have a strong breadth market, you have a robust engine for gains, and therefore it is forward looking. And when you have fewer train cars or narrower breadth, fewer stocks are driving the indexes, that means the market's foundation is weak in general, and that makes it a lot more vulnerable to sustained or significant declines. Right. And I think what we're seeing right now is a bit of a mixed condition. Nothing that we haven't seen before, certainly in the context of this market over the last 10 years, where you've seen really the dominance of these mega cap stocks come to the fore, which makes looking at the indexes, if you think about it, because they're market cap weighted, right?
Right.
It makes it a little bit confusing at times and almost like illusory. So you don't know exactly what you're seeing is concentrated strength or broad-based strength necessarily just by looking at the price index. So that's what we do. We look under the surface.
You're looking under the surface, but I'm sure you would agree that volatility has been relatively low right now. So, I mean, are we currently in Q4 right now with just a rapidly accelerating market? Would this be considered a stressed environment?
No, I would not characterize it in our system called the Defender. It would not characterize it that way. Resilience has been a defining feature of this market since, certainly since the April low, or we haven't really even had a pullback, right? And right now, the market's in a spot where risk taking is still being rewarded, right? But our breadth measures are sort of on watch. Now, we're watching them. That doesn't mean that there are signals. Just because you have a condition in place doesn't mean that there's a signal or an action to be taken. So the key for us and what we're watching is to see if participation narrows or expands after we get through this consolidation period into the next highs, which is, to us, very likely.
Okay, so let's take that a little bit further then. So, was there any stress period? I mean, I would imagine when the Liberation Day occurred, would that be considered a stress period?
So again, because breadth is forward looking, our indicators got us a signal to sell on February 24th. So
Right.
just 3 days after that all-time high in the markets, we had a sell signal which said sell 1/3 of your equity exposure. So in other words, lighten up, because we see this fragility that had been in place at that time since, by according to our indicators, since about November, had started to come to a point where it was critical mass and it was starting to crack, even though it hadn't cracked on the surface of the price indexes. Under what we were looking at was saying, hey, there's a crack here, and this is going to be potentially dangerous. So that would be an indication of a sort of a fragility, a point of maximum fragility where we actually did get a signal.
Yeah, that's pretty awesome because you're right. You timed it perfectly in February. So I have to ask you though, the inverse of that, when did the buy signal come back?
So buy signal came back early this summer. It was sort of an atypical bottom. But at the end of the day, our service helped our clients avoid a 19% drawdown. Our drawdown was only 8.5%, even if you just invested in the S&P 500. So at the end of the day, getting back in a little bit later wasn't necessarily detrimental because you didn't have to take that stressful loss and potentially introduce yourself to those potentially emotionally charged decisions like selling at the bottom. That's what people do sometimes, right?
Mhm.
And it also gets you back in at a point where, okay, things are actually all clear now, so we don't really have to stress or worry too much about getting fully invested again.
So your proprietary system, the Defender, it's named, then does that take into account political policy? So because as you know, the big sell-off was when the president brought out the tariffs and talking about how many tariffs, and he had some crazy calculation that defined what he was going to do going forward with the tariff war or trade war. So with that, did your system actually calculate that, or was it looking at just strict breadth, just looking at market fundamentals, that technical analysis?
Right. Yeah. Strictly the technical analysis, strictly looking at breadth, with the assumption that the collective intelligence of the entire market ecosystem, including all the algorithms and the people who program them and the big money, the smart money, all that goes into breadth. You can't fool that. How many stocks are going up versus how many stocks are going down is a measure of liquidity. It's a measure of risk appetite. And the Defender service is really just a means of defining in a rules-based way when to dial equity exposure up or down and by how much based on breadth. So it's basically like a thermostat for risk, if you want to think about it that way.
Oh, I like that. The thermostat for risk. That is brilliant, actually. So that said, where do we stand now? I mean, if you're forward looking, how are we looking into 26?
Yeah, so far, again, breadth has done just enough to maintain a healthy market condition. There's been a disconnect certainly between the small caps and the big caps for much of the last 2 or 3 months. And you've seen the small caps kind of move in fits and starts, and they've done just enough to make breadth be sort of okay. But it is just okay. Whereas earlier in the recovery, it was actually quite strong. I think what we're probably seeing, though, just in context of what we've been through, is more of a consolidatory period rather than a topping process. So we're still pretty constructive. At least the Defender hasn't sniffed out any major market tops at this point or inklings. But again, we're always paying attention. The system is always watching. So that's the beauty of it. Risk management is something that, to me, it's just a discipline. And it's almost like a seatbelt, right? Where you don't really notice it most of the time, but it's there to protect you when those conditions change, right? So you always want that look at.
So is the Defender looking at just, I'm learning as we go. I know the audience is as well, but
Yeah.
is it looking at the entire broader average, or can you knock it down and look at specific sectors?
So we look at the entire stock market in the US,
Okay.
right? And since most markets are correlated to the overall US market, we can make certain conclusions about different sectors and even markets outside of the US, depending on their correlation to the market. But it's indicators like the advanced decline line, like new highs, new lows, the percentage of stocks within 20% of new highs, the percentage of stocks above their 200-day and 50-day moving averages. These just numbers, right? And what they tell us about the market's health.
So how long do you have to, I mean, I'd imagine if the Defender gives you a signal, bullish or bearish, you still need to have confirmation of that. How long do you let the Defender continue to pump out signals before you actually make a move?
So the way that we've designed Defender is to be maximally invested as much as it possibly can be, right? We know that 75% of the time the market is higher. We know that. So our philosophy is that, hey, we want to be as long as much as possible, and the hurdles to get out are very high. We just want to systematically avoid that 25% where stocks are going to be potentially lower. And when you do this, the compounding equation, of course, gets supercharged. So what we really are trying to do here is only turn that defense on when we really need to. So it's a very slow moving system. It's sort of my long way of saying it's a very slow moving system. There aren't very many signals, and when there are, they're very high conviction signals.
Okay, so the high conviction, is there is it 100% bullish, 100% bearish, or is there some type of allocation where it says maybe being overweight technology but underweight healthcare, for example?
Right. It wouldn't go down to the sector level, but it is gradiated. Like I said, it is sort of like a thermostat. So it would go out in thirds. So the first signal would be proofs to get out 1/3 out, right? And then there'd be another set of proofs to get another third out, and then potentially, and this is really rare, another set of proofs to get completely out. So 0% invested. That's when we see major bear market, major evidence of a major bear market. And we really, again, we want to avoid that. So it is just gradiated in that way. And on the way back in, because you have usually this big asymmetry between expected return and risk at that moment after a bottom or close to a bottom, you have that asymmetry. So you want to take full advantage of it. And that's when we're just sort of all back in. So it's not gradiated on the way back in. It's just gradiated on the way back out.
So how important is it to clients, to investors, to manage risk? And what I mean by that, I know it's a loaded question, but what I want to know is, should investors put more energy into managing risk than actually managing their portfolio?
I think, and this is sort of just me, if you look at the data, right, and managing the risk part of the equation is the one that's more overlooked here, right? So I think it's the most important to manage the risk because again, anybody could just sort of buy and hold. And certainly for the last 17 years, that's been a great plan. But there are periods that go decade plus long periods where you have a sideways market or you have an up down market, 2000 to 2013, you didn't go anywhere in the indexes. Then in an environment like that, you want to at least have a plan for what to do, how to be more tactical, when you actually need to be. And that's why I call Defender an adaptive risk management process, because that's what it does. It adapts to the market condition. It doesn't predict. It doesn't tell the market what it should be doing. There are no opinions. It is automatic, and it is always watching. So being adaptive in terms of risk management in that type of environment is something people really need to consider.
So how long has Defender been around?
So I launched it at the start of this year.
Okay.
And I had back tested it all the way going back to 1988, right?
Wow.
So yeah, and there's been, if you do it on the S&P 500, it adds about 600 basis points per year on average. Most of that comes by avoiding the bear markets. And you'd be surprised what that does to the math equation. Just to give you a sense, if you start with $1 million at the beginning of that period, by the end of that period with Defender, you have 89 million. And with the S&P, just S&P, buy and hold, you have 19 million. So both phenomenal results, but one's clearly much better than the other. Again, it just goes by avoiding those big drawdowns in a systematic way. And we're not perfect. The system is by no means perfect, but certainly 80% of the time, it's on the right side of the call.
So you're back testing. I'm fascinated by this. You actually saw a 6% increase on average, I'd imagine, increasing the annual average return because of the Defender system.
Correct. With 30% less volatility, because again, you're not taking those big drawdowns. So it's a rare combination of finding almost like a sweet spot and without over trading. There are systems that can achieve those kind of results and much better, obviously, but they're trading all the time, right? This is very, very slow, very gradual, and something that again, it's just based in breadth. There's no opinions. There's nothing else. I'm not saying I'm smarter than anyone else. I'm just saying the market is smarter than most people. So let's just listen to the market.
Well, you may not be smarter than what you're saying, but your system is. I mean, that's an incredible return. So with that, I mean, if I'm an investor, I'm going to ViewRight and I want to invest with you. Do I need to pay extra for the Defender system?
Yeah, so right now, the Defender is offered to financial advisors as a
Okay.
system that offers these signals. And we just actually have an ETF product registered with the SEC right now. It's in review. So that's something for early next year that we can begin to talk about. But so there is a solution for individuals pretty soon, because that's something I've been getting a lot of questions about is, as an individual, how do we access this? Because my advisor is just buying and holding and leaving me to sort of my own devices. What
Yeah.
do we do? And the advisors come to me and they say, I really love your service, but taxes, we don't want to pay taxes. Being tactical means I got to pay taxes. And of course, being in an ETF structure, you don't have to worry about that.
Right, right. So let's turn the page to ViewRight then, because this system is amazing. Now, is ViewRight an advisory firm where you actually are looking to take custody of assets working with advisors, or are they just simply purchasing your trading signals?
Right. It's a subscription-based service that gives the advisors clear rules-based signals on, again, when to dial up that exposure, when to dial it back, by how much. Really, we're just trying to protect as many people as we can from those big losses, emotional decisions, the over trading, and really missing out on the gains too. Because I think, one of the things that I've found, at least in my career, the people who had got it right on the way out, either they're lucky enough or smart enough to sort of get out of the way of the big bear market. One of the things they really struggle with is getting back in, right? Because you sort of convince yourself that you're right in that sort of bearish or negative view. And then when it's time to buy, you can't do it. You don't want to. So this sort of forces that issue as well. But yeah, so it's a subscription-based service.
Yeah, and I looked at your background too, Vincent. I mean, you have a very deep background. You worked with who I call the GOAT is Sam Stovall. So he's
Yes.
kind of the Andy Reid of Wall Street now, with so many the tree of experts that are coming out of his that's working with him, and you're one of them. So with that, are you looking to create any other systems that may be more sector specific or even individual equity specific?
Yeah, it's on the horizon. I can't really speak too much to it, but we do have sort of um, rotational sort of risk on, risk off in the works, and that could be something that's down the road, probably for an ETF, probably for another ETF, and a bunch of other ideas. Applying this framework, it's very flexible. You can apply it to any portfolio that's correlated, and that's what gives us sort of a Pandora's box of what we can do with it.
Yeah, that's amazing. So, how can advisors go and find information on this?
Yeah, so you can look us up. ViewRight.ai is the web address, no .com. So ViewRight.ai. And of course, I'm on LinkedIn as Vincent Randazzo, CMT. You can find me on LinkedIn. And of course, I'm on X as CMT Randazzo. So feel free to reach out and, we can have a conversation, see if there's a fit.
Well, I know the show is airing live right now, so when we have the post-edited version, look here on the bottom of the screen. You could go to viewright.ai. You definitely want to check it out and see what Vincent has to offer, because this is amazing. 6% increase is truly amazing. That's some delta that I know a lot of people could get their arms around. So that's great news. Vincent, I want to thank you for joining me today. I know it's Veterans Day. I want to thank everyone for tuning in as well, but I know you probably got a lot going on today, especially with so much going on out of Washington as well, that could be potentially moving markets later on. But I
Yeah.
do hope to have you back again.
Thank you, Todd. Thanks for having me. I look forward to coming back.
Absolutely. So on behalf of Vincent Randazzo, I am Todd Schoenberger. Thank you once again for joining me on The Money Path. Coming up tomorrow, we have Barbara Duran. She is going to be live for a one-on-one exclusive at 11 a.m. You definitely want to tune in and hear what she has to say. So until then, take care. We'll catch you next time.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.